Tax time as an investor doesn't have to be confusing. Here is everything that you need to know. Welcome to Get Started Investing, a podcast that helps you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
Bryce, I'm very good. Very excited for this episode. Nothing more exciting than tax.
Yeah.
You know, some people wait 12 months until Christmas. You wait 12 months until you can do your tax return.
That's it, baby.
So in this episode, we're going to be giving you everything you need to know about tax as an investor. We're going to cover capital gains. We're going to cover income, things like dividends. We're going to talk about differences between different asset classes you might be invested in. We're going to talk about deductions. And then finally, we're going to close with some ATO hotspots for 2025. They've been public about some things they're watching out for.
Yeah.
Bryce does all of them, so audit him, not me. But we'll chat about what they are looking for. So, a big episode, Bryce, but we should say thank you to our long-term sponsor here on Get Started Investing, BetaShares Direct.
That's it. BetaShares Direct makes tax time very simple. At the end of the financial year, you'll get a single tax statement covering all of your investments that you held in your BetaShares Direct account during the year. No more chasing PDFs or manually calculating those capital gains. And at the end of the financial year, you'll receive a single tax statement that's sent to the ATO so that it can be pre-filled on your tax return.
Sold anything this year, you'll also get a separate capital gains tax summary showing any capital gains or losses, making it easy to stay on top of your tax.
So head to betashares.com.au/direct and make tax time smarter this year.
BetaShares Capital Limited is the issuer of BetaShares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for info on other fees and costs.
All right, Ren. Well, we've made it to the end of financial year. Congratulations.
Thank you.
Big momentum.
Another year older, another year wiser, as they say.
But here's why tax time matters for investments. For investors, I should say. Firstly, it's not about how much you make. It is how much you take home.
Okay. Yeah.
So tax time matters because it's your opportunity to ensure that you are maximizing your take-home salary or your take-home income.
Yes.
I think Rene Rivkin once, actually, I'm not going to say that.
No, Kerry Packer said you guys don't spend it well enough that I'd give you more.
Something like, What was it?
Rene Rivkin just got done for insider trading.
I know. That's what I was like. I'm not going to use this guy as an example.
Nothing wrong with minimising tax. I don't know anybody who doesn't minimise their tax. I am not evading tax in any way, shape or form. Now, of course I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you're not spending it that well that we should be donating extra.
So yes, minimising tax is important at this time of year. Secondly, though, this moment, Ren, can get really confusing and overwhelming and administratively difficult.
Yeah. Which is why you just don't pay tax.
Okay. Any comment that Ren makes throughout this about no tax avoidance, people do take your comments seriously.
Yeah.
I don't.
People still believe you smoke.
I know.
Which he does.
Ren is taking the piss. What taxes as investors do we need to be aware of?
Well, you don't pay any. Let's see if I can break Bryce by the end of this episode. All right. So I think we talk about tax in two different ways. We speak about capital gains and we speak about income, like dividends or yield from bonds. But the important thing to know as an investor from a principal point of view is they have different rules about how they're treated. But once they're treated, all of the money that we make rolls up into one big number, which is our assessable income. So why is this important? People often think there's like different tax rates for different ways you make money. People think, what's the tax rate on capital gains? Or what's the tax rate on dividends? But there's no specific tax rates for different types of money that you make. You get taxed at your marginal tax rate on your assessable income.
Yeah.
And so there are different rules about, capital gains tax discount and stuff, franking credits. We're going to speak about all of that in this episode. But it's not like the different ways of making money get taxed differently. In Australia, it all rolls into your assessable income. And then it's just whatever tax bracket that falls into is your marginal tax rate. So capital gains and income, there's different rules around each of them. But really, at the end of the day, what matters is your assessable income. And I guess the name of the game is to make your assessable income smaller, using some of the tax tricks that you're about to teach us.
That's it. Yes. Watch this. So let's just unpack capital gains. If you're new to the game, capital gains is the profit that you make from buying and selling an asset if it increases in value. Capital gains tax is the tax that you then pay on that profit. So if we use an example, you've bought 100 CSL shares or Combank, whatever, at $200. So that's $20,000 that you've outlaid for the investment. You sell them 2 years later when they reach $300. So that's $30,000 in total. You've made a capital gain there of $10,000. Now, to bring it back to Ren's example, that $10,000 is then added to your total assessable income, which is then taxed at your marginal tax rate.
Nice. So that's capital gains. Now, that was an Australian example. A question we got from Caitlin was about capital gains on overseas shares.
Hello, equity mates. I had a question about tax implications involved in investing. I'm only 18, so I'm pretty new to tax returns and whatnot. So I currently have holdings in a few beta shares ETFs, thematic ETFs, and I've only just recently invested in NVIDIA shares on Superhero as well. So my question is, do I actively have to record my transactions in foreign currency exchanges for tax time and tax return, etc.? Any help would be appreciated. Love the podcast. Thank you.
Thanks, Caitlin, for your question. A reminder that anyone can ask their question. Go to equitymates.com/contact. Would love it if you record a voice note like Caitlin did. But really, to answer Caitlin's question, Bryce, I think the starting point from a principal point of view is the ATO cares about all of your transactions in Australian dollars. So you don't need to record, what you bought or sold in US dollars in this case for NVIDIA shares. What they care about is what was that in Australian dollars.
Yeah. All of your international investments, no matter where they are, capital gains comes back in AUD and you're going to be treated as normal.
Yeah. So if a broker like Superhero, you're just transferring money into US dollars and then that sits in US dollars and you're buying and selling in US dollars, what you'll need to do if Superhero doesn't do it automatically in their tax reporting, I'm actually not sure if they do, is at the time that you bought the shares in US dollars, you'll need to just calculate what that was in Australian dollars at that time.
Yeah, all the reports will give you that.
Yeah.
It'll tell you exchange rates and all that sort of jazz. They a lot of the brokers these days make this sort of stuff pretty straightforward.
Yeah, and so we're using Caitlin as an example there because she uses Superhero, but Beta Shares Direct, our long-term sponsor here at Get Started Investing, same thing.
So you mentioned capital gains tax discount earlier on in the piece, Ren. This is probably a good point to discuss because this is where people can get confused. A capital gains tax discount is where if you have held an asset for over 12 months, you get a 50% tax discount on that capital gains.
So let's use your previous example.
So if we use the previous example, we'd made $10,000 in capital gains buying CSL shares.
Yep.
Because I'd held those shares for over 12 months, I'd held them for 2 years, you halve that, you get a 50% discount. And so all you're paying tax on is actually $5,000 of the full 10,000.
Yeah. So rather than 10,000 being added to your assessable income, only 5,000 gets added to your assessable income. A lot of people think the capital gains tax discount is like a lower tax rate, but it's actually, you're just halving the amount that is being taxed.
Yeah. Pretty significant though.
Massive.
So you need to be very conscious of how long you've held your assets for to be eligible for the capital gains tax discount.
So the setup for this episode was we're going to explain tax, and it's all about knowing what your assessable income is and then the ways that investors can reduce their assessable income. So way number one is reducing your the capital gains that you pay tax on by using the 50% capital gains tax.
Yes.
A second way you can reduce your assessable income is with capital losses. And Bryce, you know this very well.
Well, this is very handy. It makes you feel a lot better about some of the losses that you have in your portfolio.
Yeah, it gives them purpose.
It gives them
you
purpose.
losers purpose.
It's like, you know what? You're doing a good job. So just like you can get taxed on a capital gain, the ATO says, you know what? We're going to, give you some reprieve for any losses that you've made. And what they allow you to do is offset any of the gains you've made with any of your losses.
So let's take the example we've been talking about, CSL. You earlier said there was a $10,000 gain on it. Must be nice.
However, I've also invested in Zip. And unfortunately, over a couple of years, I've lost $5,000 on Zip.
So now let's apply the capital loss and the capital gain together.
So we take the 10,000, we minus the 5,000 loss, which leaves us with a net capital gain of $5,000. From there, we then apply the 50% discount. So I have a capital gain of $2,500 that I'm going to get taxed on.
Yeah. So it's $7,500 of the capital gain is now tax-free.
Yep.
I mean, you did lose 5,000.
I did lose 5, yes.
But yeah, I guess that's the beauty of it. That's another way you can minimize your tax.
Yes. Now, the beauty with capital losses as well is that you can carry them forward year on year.
Yes.
But you have to record them. You can't say, oh, actually, 5 years ago I sold and I forgot to tell the ATO about it. You have to record the loss every year. And then it's not until you make a capital gain that you can sort of bring that forward and use it to reduce your income.
Yeah, I mean, like to build on your CSL example, let's say you made the $10,000 gain in CSL in 2025, but you lost money on Zip in the tech crash in like 2022 and 2023. If you didn't claim it in that year, then it's just gone.
Yeah.
Yeah,
you've missed it.
But if you had claimed it in 2022, you could have just sat on it for as long as you needed until you actually made some gains.
Yeah.
Yeah.
And claiming it is pretty simple. You need a record of it, but there is a part in your tax return where it's pretty much capital gains, capital losses. You just put it in there and away you go.
So Bryce, we recently did an episode on how much of our portfolios have changed between 2020 and 2025. And this sparked a question from Julie all about how we managed the capital gains.
Hi, I just heard the episode about your portfolio in 2020 versus your portfolio in 2025. Did you offset capital gains by selling loss-taking shares, or did you just cop the capital gains? I just wanted to understand how I can rejig my portfolio without a big capital gains impact. Thank you.
Thanks for the question, Julie. It's a good one, Bryce. How did you just didn't pay your tax. ATO's still chasing you.
Not true. How do I approach this?
How did you approach it?
How did I approach it? So I've never really tried to play the game of trying to, offset and whatnot. For me, it's like the most important thing here is to get the best outcome for my long-term investments. And if I've made money and I have to pay tax on it, I'm happy to do that. Of course, there were some losses that I did put in there, but I never really worry about it if it's to set foundationally what I believe is going to be a good long-term outcome.
Yeah.
How about you?
So you quoted Kerry Packer, your hero. I'll quote Warren Buffett, my hero. It doesn't bother me about paying taxes. I think I've butchered his quote, but that's okay. Like if you've made money and you've got to pay tax on it, like sure, claim the discounts and all of that. But at the end of the day, we made money.
Yeah.
That's a win.
Yeah.
And that's the tax is the cost of doing business essentially. And so I wasn't too worried. I also had the view, and I still do have the view, that like if the portfolio is suboptimally set up and you're missing out on returns because you're not buying the right things and your portfolio doesn't look good, it's more important to get the portfolio right. So yeah, similar to you, get it optimized, get it right, and then dollar cost average over time.
Yeah.
We should say though, like we're speaking from perspectives of, early 30s, long time horizon ahead, not a heap of capital gains in the portfolio. If we were, 20 years from now, if we're in our 50s, and we've got like hundreds of thousands of dollars of capital gains in the portfolio, we're probably having a different conversation.
Definitely.
For starters, we're probably having a conversation with an advisor.
Yeah, absolutely.
Yeah.
So that is all there is to know high level about capital gains tax discount, and the capital losses. Let's move to the second component when it comes to investing, Ren, which is understanding the tax on dividends and the interest that you're earning.
Yeah.
So you can get paid dividends, yield, interest, whatever you want to call it. This is a form of income that is taxed at your marginal tax rate. There's no discounts applied to it like the capital gains tax. It's just income straight into the back pocket that you hits your marginal tax rate.
Yeah. So there is one discount. There's no capital gains tax discount for holding the asset for longer than 12 months. But there is one thing that you need to be aware of, which is franking credits. So the principle behind franking credits is if a company has already paid tax on profits, then the government says, well, you as a shareholder in that company shouldn't pay tax on that again. It avoids double taxation. Australia is one of the few countries in the world that actually has this as a principle in tax law. Most governments just say, we'll tax both the company and the investor. But in Australia, you get a credit. So let's use an example. Let's use Commonwealth Bank. Let's say they've paid a 30% tax on their profits, which is the corporate tax rate here in Australia. And then they pay it out to you as a fully franked dividend. And let's say your marginal tax rate is 37%. Then you won't pay 37% tax on those dividends. Instead, you claim the franking credit and say, hey, this money's already been taxed 30%, and then you will just get taxed on the difference. Yep. So that'll be a 7% tax in this case.
But you know what, Ren? Tax time doesn't have to be a headache.
Not when you're with our long-term partner here on Get Started Investing, BetaShares Direct.
That is right. Well, you can access ASX-traded ETFs and over 300 Australian shares brokerage free. It also offers easy performance tracking, and at the end of the financial year, you'll receive a single tax statement that's sent to the ATO so that it can be pre-filled on your tax return.
If you're thinking of bringing your portfolio over, you can transfer your existing holdings without triggering a capital gains tax event, as long as there's no change in beneficial ownership.
So streamline your investing, especially at tax time with BetaShares Direct.
BetaShares Capital Limited is the issuer of BetaShares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves a risk. Refer to the PDS for info on other fees and costs.
All right, well, we have a question here from Simon to close out the discussion around franking credits.
G'day, Bryce and Ren. Big fan of the show. You know you're part of the right community when you've been preparing for a cyclone all day and the only time you've had to sit down, you start to think about franking credits. Anyway, the reason for my message today is more of a request around franking, obviously. Just if I could get you guys to have a breakdown of how franking credits work, especially around tax time, whether the ATO keeps track of your franking credits for you. I've also heard of a rumour of the 45-day rule. If you could shed some light on that as well, it'd be highly appreciated, because I know we all love franking credits, but as someone that's a new investor, it's just a little bit to get my head around, especially doing my first tax return. Any help would be greatly appreciated. Thanks, guys.
Thank you, Simon. Love the question. Thinking about franking credits while in the middle of a cyclone. Good on him.
Yeah. I think the key thing, Simon, is you need to keep track of your franking credits, but most brokers these days make it very easy. Some will have a separate report, like it would be like a dividend report. Others will just have a comprehensive tax report, and they'll show you your dividend income for the year and then your franking credits for the year.
Yep. I would, ShareSide as well does the same thing. And yeah.
And then the 45-day rule. So the rule is that if you want to claim franking credits, you need to have held the investment for 45 days. If you own preference shares, 90 days for certain preference shares. That's not relevant for stock market investors most of the time. But here's the good news, Bryce. For most of us, there is a small shareholder exemption. So if it's below $5,000 in franking credits per investment, the 45-day rule doesn't apply. So if we assume a 30% tax rate, which is the standard in Australia, that would be the equivalent of receiving an $11,666 fully franked dividend.
Nice.
So until we're getting $10,000 in dividends from one investment, 45-day rule doesn't apply.
Alrighty, well, let's keep moving. So we've got a question here from Roxanne that is particularly relevant for everyone who is automating their investments and dollar cost averaging.
I use dollar cost averaging to buy ETFs every month. I do my own tax and all of the info is just fed into MyGov at the end of each financial year. Is there something else I should be documenting for tax in the future apart from what is already tracked in my brokerage account? I prefer to do my own tax now because so much of it is automated.
Great question, Roxanne. I think we do get this quite often is, should I be tracking every time I buy fortnightly, monthly, whatever it is? I think the answer is, as you've noted, if it's tracked in your brokerage account and you can clearly understand when you bought something and at what price, that's really what you need to be tracking.
So that's the investing side of it. And the good news is, as Roxanne's noted, that the investing platforms these days track it for you, but then also feed it into MyGov. Good news for most of us, not good news for Bryce, who tries to funny up the numbers. But there are like non-investing costs that you should be keeping track, because obviously your brokerage won't be aware of them, so won't be feeding them into MyGov. And this is the introduction to the conversation around deductions, which is always a big conversation because people are always a little bit confused about what's deductible and what's not deductible. So from a tax principle point of view, the ATO allows deductions where they are costs that are incurred in the production of assessable income.
Yeah.
And so that's not super helpful, but that's the principle. So why don't we get into some of the details? What are some of the costs that are deductible because they do meet that costs that are used to produce assessable income principle?
So one that's relevant to me is the share site subscription, which is the platform that I use to track all of my investments that produce income. So sort of the subscription that you pay to manage your investments. So think about the platforms you use is a tax deduction.
Yeah, the easiest one is interest on investment loans.
Yes, the interest you have to pay.
Yeah, so that's why investment property loans are tax deductible, but your home, like your primary place of residence, is not tax deductible because the investment property produces assessable income that the ATO can tax.
Yeah.
Your primary place of residence does not. So that's an example. There are also investment loans, like we have NAB equity builder loans that we use to invest in shares or manage funds. Though the interest on those loans, tax deductible, because the investments produce assessable income.
Yes. The other one is financial advice fees or accountant fees. Now, when it comes to our financial advice, it's very important that it is the portion of advice that is directly related to investment decisions. It's not the entire financial advice. So just something to be aware of, but you can deduct, and any accountant fees to use to prepare your tax statements, that is a deduction.
Yeah. So there are some other ones. Investment subscriptions like the Motley Fool, for example, may be tax deductible. Again, it's all about the principle of using them to produce assessable income. If you subscribe to the Motley Fool and then don't make any investments, probably not tax deductible.
No.
Similarly, if you're traveling to like a company's AGM or something like that, and that's, to further your investments, which produce assessable income, again, that may be tax deductible. When you start to get into those deductions though, it's worth speaking to an accountant.
I'll tell you one thing that is not tax deductible and is always brought up, and people trying to claim it. I get it, because you could say it's to do with my investments. Brokerage is not tax deductible.
Nice.
Yes. So just don't ask in the Facebook group.
All right. Well, let's keep moving and close this out. We've said that all investments, income, capital gains roll up into your assessable income, but are there any other differences between asset classes that we should cover off?
I mean, all in all, it's pretty standard across the board, but there are some slight nuances. So let's start with shares and ETFs. As we've said, there's a capital gain tax when sold. There's a 50% discount if you've held it for more than 12 months. And the income tax on dividends, you've got the franking credits that you can use there. The difference, though, is if we're looking at like investment properties, for example, again, there is a capital gains tax when you sell. There is a 50% discount if you've held it for more than 12 months. You have to pay tax on any rental income that goes to your taxable income, but you can claim the deduction on the interest on the loan or negatively geared.
Crypto. We haven't spoken about crypto yet, but tax rules apply. It's the same. Capital gains tax rules apply. Importantly, even swapping one token for another is deemed a sale and it's deemed a taxable event. So that's important to keep track of. 50% discount for capital gains tax, that applies. Capital loss, claiming those, that applies. Income tax on yield you make if you're staking your tokens or anything like that. Treat it like any other asset, because the ATO will treat it like any other asset as well.
Yeah. Well, speaking of ATO, we said we'd close out with the hotspots for 2025, what they are keeping an eye on. And this has come from the ATO. They do it every year. They warn people, hey, we're going to keep an eye on this, so don't try anything funny. Some of the red flags it starts with undeclared crypto transactions. So you've just got to be super, diligent with tracking your crypto transactions and reporting them. Overstating work from home expenses. This is a big one. Oh, I work from home, so I've got the table, I've got the chairs, I've got my lights.
Also, it's like portion of internet, portion of phone bill.
100% of my internet. Yeah. So speak to your accountant, because there are two ways that you can claim working from home expenses. And then, of course, inaccurate record keeping. Make sure you've got everything to be able to back it up.
Yeah. Now, the ATO is also, like everyone, finding ways to use AI and you know different tools. They've got this data matching program with crypto exchange and share broker platforms. And last year, they issued more than 300,000 letters to Australian taxpayers for mismatched investment income. I wonder how many of those you received, Bryce.
Not a single one. I'm clean, baby. So that brings us to the end of our tax bonanza. There's a lot to get your head around. I know it can be overwhelming. Luckily, as a couple of community members noted, the ATO does now get automatic feeds from a lot of your brokers and your platforms and do it for you automatically, which is great. But equally, there are a number of affordable tax accountants that you can go and speak to ensure that you're not missing anything. I highly recommend doing that. You will certainly not regret it.
Final thought. Tax time might be overwhelming, it might be complex, but remember that investing is worth it, that paying tax is just the cost of doing business, of making money in investing and making your money work for you. So don't let it put you off, because the benefits far outweigh the costs. So that, I think, does it for our tax episode in 2025. I have no doubt we will be doing this again this time in 2026. So until then, a massive thank you to Caitlin, to Julie, to Simon and Roxanne, all for asking questions. You can ask your questions at equitymates.com/contact. But Bryce, any final words for the ATO?
Love your work.